Hello there, welcome back. It's good to have you here at this stage in the course. By the end of this module, you would have officially finished the first half of PEERFEST. We would like to hear from you. How has it been? Are you enjoying the courses? Are you being impacted? More importantly, are you gaining things that you are able to apply immediately? I'd like to hear your feedback. We have various channels for that. You can send feedback via email on our group, and you can also give us a call. Today we are going to Module 5, Bookkeeping. Bookkeeping has to do with the recording of the day-to-day activities of a business. We're going to be talking about the basic yet vital documents that your business has to keep. The records, it must make sure that are up to date and are available on demand. Bookkeeping is one area where you should not compromise with your employees. The reason is because you're not the only one who has the right to inspect your company's books. The government has a right, and tax inspectors, tax auditors can visit your premises at any time. We'll be talking more about taxes in a later module. So you have to be ready for them to visit you at any time as long as you are registered. Of course, you also need to keep records so as to monitor internally. You want to have a situation where you can easily pick any errors or frauds happening. You also want a situation where you can have adequate records which you use for budgeting, which you use to make decisions on investments, and even to justify pay raise of your employees. So it is very, very important. As a matter of fact, there are 5 essential business records that every business must have, and I'll go through them sequentially now. Number 1 is invoices and receipts. Everything you buy, no matter how small it appears to be, because it is not your job to determine whether something is material or not. That is the job of the auditors. So you must have all the invoices ready for them to make that decision on what is material and what is immaterial for your business. Secondly, your cash expenditures, how you are spending money. Ideally, you don't just go to your banking app to make a transfer without a source document. There should be a conversation which has happened to justify that expense. It could be something as simple as a memo. An employee has written, we need this and this in our department. That justifies the expenditure. So that goes along with your entry in the bank, in your banking app, to say this is a record of cash expenditures. So you will be keeping all those memos, and you should actually have a register for tracking them. Today we spent 20,000, yesterday we spent 5,000. This week alone we spent 100K, and then you are able to decide, is it justifiable? Is there a way we can start to cut costs? Without the records, how will you even cut costs and make sure your business is more profitable going on? Number 3, employee records. You need to have a complete file on each employee. Their CVs, their certificates, even what they look like, that's their passport, information about their next of kin, their health records, because that could make you liable to some health insurance claims if you don't know of any existing condition before they entered your employment. So you should have basic information about them. Maybe they have any condition which your workplace becomes hazardous to them. So you should have those records, full employee records, their next of kin, what happens to them, what happens to you as a business if they suffer a mishap in the course of their work in your premises. So you should have a file on every employee. Then payroll, what we paid to every staff, what we paid this month, when we paid bonuses, when we gave a special payment as a bonus to someone or to an entire group. You should have payroll records. So it's not just saying you're printing your statement and everything is lumped there. When you print your statement, you see everything there, what your customers have paid, what you've paid to your suppliers, then the expenditure also goes in there, the staff payment also goes in there. Without the separate documentation to explain what is what, the statement is useless to an auditor. So you need to have these records to even make them able to make proper sense of the bank statement you would also be providing. And your business permits. Usually we have local government, the council people come around to say, okay, we want to impose such and such a levy on you. But before you even start paying levies, you must first ensure that you are permitted to operate the kind of business that you're doing. For instance, you are running a school, you need to have certain level of approvals before you can put other people's kids in your premises. Or you have an hospital, you need to have approval from the Ministry of Health, you need to have a pharma certificate, or whether you're a pharmacist, you need special permits, and they must be visible on your premises. You must display them or be able to bring out a file immediately and be able to show the interested official, this is our business permit. Legal documents, the agreements you are entering into, your MOUs, your contracts, you should have them on hand. Expense register, we've mentioned that too, whether cash expense or the things you do via transfers that are not in cash, you must actually register them. Your purchases book, how you restock, especially for those who have physical products. Today we bought goods worth 1 million, next week you are buying 1.5 million. You should have a record of it, because that might be the first indication of whether what is entering the bank as revenue tallies with the level of purchase you are making in your business. So you have your purchases book. It is not just sufficient to transfer money to the supplier, you should have a record of it. Your sales book, we know that money is entering the account and your statement is accurate. Have a sales book. Like I said, all kinds of money enter the account. Revenues, expenditures, contracts for projects you're executing, and then you are making transfers out of the account. Some are for salaries, some are to pay suppliers. So different money goes in and out of your account. It is these records that enable you to make sense of it. So you should have a sales book. Your inventory records, what goods you have in your store, that is your stock book, which means as you are doing stock counts, you'll be updating that record and make sure that it exists in written form. And your tax returns, when the tax people come around, they want to see that you are making accurate returns as and when due. And the best way to show it, of course, the system is theirs. The system you are using to make your remittance is back there at their office, but they still want you to show them a document that proves that you're actually paying your taxes. And you sure don't want to tell them to go back and check on their system. No, you should be able to show them. And your accounting records, these are your statement of accounts, your income statement, which is your profit or loss, your balance sheet, and your cash flow statement. All these are 12 essential business records which you must have. Now, accounting is a professional field. It has its own jargons, its terminologies, and it is important for you to get familiar with what each term means. So I'll do a quick run through. Accounts payable. Payable is the account which you use to track all the money that you owe third parties. Third parties could be suppliers which have given you products on credit. That is reflected in your accounts payable. Accounts receivable is the opposite of that. That is money which you are expecting. You've supplied goods, or you've delivered your service to a customer, but they have not yet paid. They are enjoying credit terms from you. So that is reflected in your accounts payable. Your assets are simply all the things you or your company owns to help you successfully deliver your services and run the business. Your asset could be cash, could be your building, could be the goods in store, and could be the tools, vehicles, and furniture which your business has, which is used in the day-to-day running of the business and to generate economic returns. Your balance sheet is a detailed report which shows the financial situation of your business. It's going to list your assets versus your liability, and ideally everything should be equal. Everything should be equal. So if there is an imbalance, that is to show you that some records were not accurately made, and then you can begin to make those corrections. Capital is simply the money or other assets which personally belong to you or to the shareholders of the business. Not the profit, but the money which the owners of the business have put into it is called capital. Then cost of goods sold, all the money you spent on the product or services which you intend to sell to a customer. Oftentimes you have to, after making your purchase of the product with the raw materials, you still have to incur other costs before the final product gets to the customer, and those are included in the cost. Those are added to the cost of the purchase you made to arrive at cost of goods sold. For instance, I bought goods at the market. I bought it for 2,000 and I use 1,000 to get it delivered to the business premises. And of course, the cost of delivery is not going to be free. I'm going to add it to the actual cost of the material, which is 2,000. So for that, my cost of goods sold becomes 2,000, which is the actual cost of the item, and 1,000 delivery fees to bring it to my premises, and that makes my cost of goods sold 3,000. And I can then begin to do my markup based on that. Remember, these are accounting terminologies which every entrepreneur should know. Depreciation: when you buy a machine to use in your business and the machine has a lifespan of 10 years, for instance, a generator, you bought a generator to use in your business place and you know that this is a very good brand, I can use it for 10 years. After the first year, you know that the lifespan that this generator has, it's no more 10 years, it has become 9. So you should make an entry in your business records to reflect the fact that this business now has further usefulness of 9 years. So you'll be reducing the value of that asset based on the number of years it has left, and that value is called depreciation. Equity is all the money you invest in the company as the owner plus all the accumulated profits. So the capital you put in plus all the profit your business has made, which you did not pay out as dividends or which you did not spend, the profit that you turn back into the business, all of that forms your equity. And your expenses, that is the money you spend day to day as you carry out your business operations. Your income statement is a financial statement which sums your financial activity and lets you know whether you are making a profit or a loss. Usually we prepare an income statement on a monthly basis, then quarterly basis, and annual basis. Liabilities are basically all the debts that you owe. It could be loans, it could be things you got on credit from your suppliers, so, or any unpaid bills which you know that you will still pay it because you have incurred it. So those are your liabilities. Payroll, that is what goes to your employee. They have worked for the whole month. It's end of the month, you have an agreed salary. So when you are making those payments, that's when you refer to payroll. And the revenue is all the money you collect in the process of running your business, the money that comes in that is normally attributable to the sale of your goods or the delivery of your service, which is saying what you get when you sell your products or what your customer pays you for rendering your service to them. So whether your service is a makeup business, so when you do makeup for somebody and they credit your account, that is revenue. Whether you are selling a wig, once you deliver the wig to the client and they pay, that is revenue. Because other monies enter the account and it's your records which would help you delineate this is revenue, this is not revenue. And remember, all the money that enters your account is assumed to be revenue unless you have records to show otherwise. And if it is assumed and taken as revenue, there will be tax implications. We'll talk more about this in a later module. In our live class, we'll be sharing 3 templates. We'll be sharing a template for profit and loss, which is the income statement. You also get a template for your statement of financial position, which is commonly called the balance sheet, and of course, a template on how to prepare your cash flow. If time permits, we'll also prepare a statement of financial position for a growing business or a large business. See you in class.